A few weeks back, I made a video talking about the imminent impact of the Russian-Ukraine war on our economy and how the impact can worsen if the war were to last much longer. Namely, our energy costs will keep rising, commodity prices keep rising, inflation will keep rising, and at the same time, the economy will also enter into a recession. In other words, stagflation, the worst kind of both inflation and recession combined. Now, after a few weeks of research, at this stage, my teeny tiny remaining confidence in the Federal Reserve is also gone, mainly because I see the trend evolving in many things has passed its turning point, and it's very difficult to turn around in a very short period. And the Fed can manipulate the demand side, but it cannot control the supply side, which is a bigger problem at the moment. I know I sound doom and gloom, but let me show you why I think so. Let's take the energy crisis. To understand how we got here, we must look how it started. Many of you think Putin started this. Well, the crisis really got worse when Putin invaded Ukraine, but that's not the main cause. I would say the main cause has been the decades-long de-oilization movement, the ESG movement. Most Western governments have heavily restricted oil industry development for years, and most investments and focus went into renewable and green energy. While I think it is important to keep developing green energy, we shouldn't neglect the oil industry, which still is and probably will be for a very long time the largest energy source powering our society. The policymakers should recognize the de-oilization as a slow and gradual transition, not an overnight switch. But if we look around, the policymakers have all been too aggressive when it comes to de-oilization. Oil is an extractive industry which requires on average $600 billion a year to operate, discover new oil fields, drill new oil wells, and so on. We can see on this chart the underinvestment has been ongoing for many years, and it accelerated during the global pandemic. After 5 to 8 years of underinvestment, the world is now net short of oil, and this situation will continue for many years to come. This chart shows you that we are short of around 2 to 3 million barrels per day already. And it is under these circumstances, which is already bad, then the Russian-Ukraine war happened, and the situation got a lot worse. Russia exports about 5 million barrels a day of crude, plus nearly 3 million barrels of refined products. And with the Western sanctions on Russia, experts estimate at least 2 million barrels a day of Russia oil exports are at risk. Although there is no direct sanction on Russia oil, Putin knows the world is unlikely to survive without Russia oil, so the implied risk of Russia using it as a geopolitical play is high. We have already seen that Russia demands gas payment in rubles, and I wouldn't be surprised if Russia demands the same for oil and other commodities that they export. So the oil industry really needs to extract at least 3 million more barrels a day to offset the current shortage and the potential risk. You may point out that there is OPEC spare capacity which can satisfy those 3 extra million barrels a day, although no one knows the exact spare capacity number. But the question is whether Saudi, UAE, and Kuwait are willing to provide those extra capacities. Because in the past, extremely low spare capacity caused oil prices to panic. And if those countries were to provide their spare capacity now, that would mean an extremely low spare capacity for the OPEC as whole. And no one could guarantee the oil price does not get emotional. While much higher oil prices would traditionally incentivize new production and quell rising prices, this time may indeed be different. Number one reason is the ESG concerns and restrictive government policies, which are putting a cap on drilling activity. So the decision to increase production is no longer economically motivated. Consequently, the supply deficit is likely to broaden as demand grows and supply begins to dwindle when existing oil wells are depleted, putting further pressure on oil prices. Natural gas industry is also in a similar situation as the oil industry, and the supply deficits are unlikely to be resolved anytime soon because the underinvestment has plagued the oil and gas industry for some time now. The problem is not only in the oil and gas production rate, but also in human resources, meaning that we have a drastic reduction in the pool of skilled labor in this industry. Because this industry is in general lacking available capital, workers are not incentivized to be underpaid when they compare with other high-pay industries like IT and software, for example. So shortage of labor is known. Other problems also includes shortage of critical materials and supply chain challenges like delivering and transporting oil and gas. All these issues will take years to unwind and lead to higher energy prices for a very long time. Although oil and gas prices could correct sharply in the event of a negotiated peace between Russia and Ukraine, but the underlying issue remains, and the energy prices are likely to stay elevated for a prolonged period of time. While higher energy prices are good for oil and gas stocks, they are bad for the broader economy because energy is needed everywhere, from agriculture to heavy industries to every household. Rising energy prices will cause overall commodity price rise too. 1/3 of the food costs are energy related. 80% of the cost of nitrogen fertilizers comes from natural gas. And on top of that, added fuel costs of farm equipment and transportation. Transportation and packaging amounts for 7 to 10% of food producers' costs. Fuel accounts for 20 to 35% of costs for aviation companies and around 50% for shipping companies. A rising fuel and gas price is definitely hurting food producers, so they would have to pass the costs on to consumers like you and me. A rising price in both energy and food disproportionately hurts the poor and middle class, taking their purchasing power away. They will have to spend most of their money on essentials like energy and food, leaving the consumer discretionaries and most services behind. A drastic reduction of consumption will eventually lead to unemployment rate in those areas. The higher the unemployment rate goes, the less the consumption will be. And on top of all these, the Federal Reserve is hiking rate and quantitative tightening at the same time. And the Chinese lockdown gives another shock to the already struggling global supply chain. You can see on this chart thousands of commercial ships waiting offshore to dock in the Shanghai port. Outcome of all these is clearly a stagflation. And unfortunately, I don't see any other brighter scenarios at the moment. Although things could change quickly, the effect will stay longer and the inflation is more persistent. Like I said before, the Fed tries to manipulate the demand side, but the supply side is out of control. Some say the Fed might have to raise its inflation target from 2% to 3%. So high inflation might be the new normal for us going forward. But unfortunately, I don't think our wage is going to increase more than inflation due to economic slowdown. So if this stagflation is the trend, I would suggest you cut down your debt level first. Get rid of all your credit card debts and look to cut down your spendings, like replacing premium brands of the same goods with normal brands, cooking home more than eating out. If you start to transit and adjust your living style now, slowly and gradually, you might not feel that shocking when things turn south fast. I hope you find this information helpful, and don't forget to smash that like button if you enjoy this content. And I wish you stay safe wherever you are. And that's it for today. I will see you in my next video. Bye!